Picture this for a second. You're trading a massive six-figure account, you're banking huge profits, and you're not risking a single dime of your own money. I know, it sounds like a trader's fantasy, right? But there's this whole industry, you've probably heard of it, called prop trading, that's built on that exact promise. So the big question is it a real opportunity, or is it just a really, really well-marketed trap?
So let's just get right to the heart of it. Can you actually take a couple $100, pay for some kind of evaluation, and then get handed the keys to a $100,000 trading account? That's the one question we're going to dig into and break down today. All right, first up, let's talk about the pitch. You know, the reason these companies have absolutely exploded in popularity. We're looking at the prop firm promise. Huge capital with what they claim is very little personal risk. Okay, so what exactly is a prop firm? Well, in this world, it's basically a company that gives traders its own money, its own capital, to trade the markets. And in return for you trading their cash, the firm just takes a little slice of the profits. You know, on the surface, it sounds like a perfect partnership.
And here is how they sell you that dream. It goes something like this. You pay a pretty small fee for what they call an evaluation or a challenge. If you pass it, bam, you're given a huge company account. We're talking $50, $100, even $200,000. Then you get to keep the lion's share of your profits, sometimes up to 95%, all with zero risk to your own savings and the promise of super fast payouts. You got to admit, it's a very, very compelling offer.
And this idea, it gets promoted everywhere. You see it all over YouTube. Like this one reviewer said, these firms are on the hunt for people who are strong traders. The whole story they tell is that they're basically talent scouts, looking for skilled traders like you to partner with so everyone can make money together. But of course, it's not quite as easy as just paying a fee and getting the keys to the kingdom. Oh no, before you ever get your hands on a funded account, you have to survive the challenge. And this, my friends, is where the rubber really meets the road. So let's look at a real-world example here. This is from a firm called FundedNext. Now, to pass their challenge, you have to hit a 10% profit target. But here's the catch. Your daily loss is capped at 3%, and your overall loss can't ever go past 6%. Now, from a professional trading standpoint, that is an incredibly aggressive profit target paired with an extremely tight risk parameter. Think about it. They're asking you to make 10% while never ever losing more than 6%.
And that is the absolute crucial point. You are walking on a razor's edge. You have to be aggressive enough to hit that big 10% target, but at the same time, be so unbelievably disciplined that you never, not even for a second, breach those loss limits. One bad trade, one emotional slip-up, and that's it. Challenge over.
So this all leads to the most obvious and critical question, right? With rules this strict, how many traders actually manage to pull it off and pass? Well, the number is pretty stark. A study that was published by another prop firm found that the average pass rate for just phase 1 of these challenges is a tiny 10.59%. And right there, that perfectly illustrates the business model. If only about 10% of people make it through the first step, that means roughly 90% of everyone who tries fails. They lose their valuation fee, and that fee money becomes the main and very steady source of income for the firm, whether any successful trading ever happens or not. Okay, so this brings us to the, let's say, the more complicated side of this industry. It's time to pull back the curtain a little bit and look at the unregulated reality and some of the serious concerns that come along with it. And it's not just grumpy traders raising their eyebrows either. We're talking about official government bodies like the Utah Division of Securities in the US. They've actually issued investor alerts, raising some really serious questions about the whole prop firm model and where it stands legally. And this is where the words they use get really, really important. The firms, they'll pitch you a partnership with talented traders, but regulators look at that and see a potential unlicensed broker-dealer. The firms call it a program fee, but regulators might see it as an investment into a pooled fund. They say you get to trade their capital, but regulators are asking, are you just acting as an unlicensed agent? It's a huge regulatory gray area, and that puts a whole other layer of risk on you, the trader.
Now, if you look at it from the trader's side, the complaints are usually about the tricky rules in the fine print. And a big one, as this user on Reddit points out, is something called trailing drawdown. See, unlike a normal static loss limit, this one follows your highest profit point. So let's say your account goes up by $2,000, well, your stop out level also moves up by $2,000. This means a completely normal market pullback can get you disqualified even if your account is still in profit overall. A lot of traders will tell you it feels like a rule designed to make you fail.
And this quote right here, it just gets straight to the point of all the skepticism.
The feeling among many traders is that the real business isn't about finding winning traders to partner with. No, it's about collecting those evaluation fees from the huge majority of people who fail. The whole system, they argue, is just tilted in the company's favor from the start.
And now, we get to what might be the single most important piece of information you need to know about this whole industry. And you have to dig for it. It's usually buried deep in the terms of service. And the truth is, it's all simulated trading. Even when you get a so-called funded account, you're almost always just trading in a demo environment. You're not on the live market. So when you get a payout, the firm isn't paying you from real trading profits. They're paying you out of that giant pool of money they collected from all the traders who failed the challenge.
So, knowing all of this, how can you possibly navigate this space without getting burned? Let's put together a quick final checklist so you can go into this with your eyes wide open.
Okay, before you ever think about paying a fee, you need to run through this list. First, scrutinize the rules. Don't just skim them. Is the drawdown trailing or is it static? Are there hidden rules about consistency or how big your trades can be? Second, you have to verify their payout reputation. Go to forums, go on social media, find real traders. Do they actually pay out, or is it a constant struggle? Third, understand the environment you're trading in. You have to read the fine print. Are you getting a real live account, or is it just a simulation? And finally, number 4, you have to accept the numbers. Just know that you're walking into a game where the whole business model depends on about 90% of the players failing.
So, what's the final takeaway here? Well, prop firms aren't usually what you'd call an outright scam. The very few traders who are consistently profitable often do get paid, but they are absolutely not what you'd call a traditional trading partnership. A better way to think of them as high-risk performance games with a business model that is fundamentally and heavily skewed in the company's favor.
So that leaves us with the ultimate question, one you really have to answer for yourself. Are these prop firms a genuine, though incredibly difficult opportunity for the most skilled and disciplined traders out there? Or are they just a very clever business model that has mastered the art of selling a dream to the 90% who are destined to pay for it?